Hi, welcome to this AQA A-Level Business revision video focusing on 3.5.3, making financial decisions. In this video, we're going to focus in on sources of finance, and we're going to look at the what, but more importantly, the when of different sources of finance. Just a reminder, my teaching here is separate from my teaching and consultation roles in any and all schools and academies around the country. My name is Mr. Giles. Let's get down to business. Okay, so let's get through these as quick as we can and get you on your way to another revision video. At GCSE, you probably would have learned if they're internal and external, all those kind of things, and that is somewhat important. But at A-level, it's not necessarily where the money comes from, it's what it's for. So I'll give you a bit of context as we go along. So we'll describe what it is and then when it's mostly used. Up first, we've got debt factoring. And I put that up first because it's probably the one that most people get wrong. Debt factoring, very simply, is when one business sells its debt to another business. I'm going to give you the scenario, okay? So imagine that I'm a shop and I'm buying Coca-Cola from Coca-Cola, okay? And what happens is I ring Coca-Cola and I order £1 million worth of their products. They then deliver their products and I get 30, 60, 90 days to pay, all right? Now, in that 30-day period, Coca-Cola give me a ring and say, hey, any chance you could pay your bill? And I say, no, I've got 30 days to pay. Now, they're within their rights to ask, but if they've given me 30 days, I'm within my rights to take my 30 days. If Coca-Cola need that money, what they'll do is they'll sell that debt to you, okay? So you, the viewer right now, are the debt factorer. And Coca-Cola ring you up and say, hey, Mr. Giles owes us £1 million. Can you give us £1 million and you collect £1 million? And then you're intelligent, you go, no, but what I'll do is I'll give you 900,000 today and we'll go and collect the £1 million from Mr. Giles. So Coca-Cola gets paid 900 grand, so they lose 100 grand, but they get paid today. You then ring me up and harass me for the £1 million. Okay. Now it goes a little bit deeper than that because sometimes it's a bit more nefarious. And what happens is you, the debt factor, might start adding interest or putting pressure on. We kind of joke and laugh about it, send the boys round. Okay. So it's a little bit like that. But what that does is that guarantees that Coca-Cola can get their cash injection straight away without waiting for me. But it does upset relationship between me and Coca-Cola because I don't want my debt factored. You gave me 30 days. For some reason, you didn't wait that 30 days, but Coca-Cola might not be able to wait that long. They might need that money straight away. Okay? So you sell your debt to a third-party company. You don't recover all the money, but you get the cash straight away. It's risky because you lose faith with that customer. Okay? Obviously, this is a short-term source of finance. You don't really want to do it. And it's if you're having a cash flow problem. All right? If you cannot factor debts, that's probably the right thing to do. Don't confuse debt factoring with somebody who doesn't pay their debt. It's similar, but it's not the same. If somebody doesn't pay their debt, you can, of course, sell that debt to a third party and they will recover it with nefarious means. But if someone doesn't pay their debt, you would just take them to court or you would sign it off as a bad debt, one or the other. So short-term cash flow issues, debt factoring. Up next, we've got overdrafts. This one seems to elude people a lot. I don't really know why. So overdraft is when the bank lets you spend their money. So you've all got a current account, hopefully, and you've hopefully got some money in your current account. What the bank will do, they will say, hey, look, you've got £100 in your bank. Good for you. There's your birthday money. What we'll do as the bank, because we're kind, we'll let you spend £100 of our money too, if you need to. It's there just in case. So you wander out down to JD, the latest pair of Jordans are on sale, £150. Well, you've only got 100, but that's all right. Your mate, the bank, will let you spend 50 of theirs. So you bowl into JD, you pick up your Jordans, you go to the till, you scan your phone, beep, 150. Now you are in a £50 overdraft. But unfortunately, the bank isn't your mate because they're going to charge you daily interest on that 50 quid until you pay it back. And your account will sit in a negative until such points that you pay in money. Now imagine you only pay in 25 quid, you're now still in a £50 in a £25 overdraft. So until you clear that 50, you're sat in your overdraft getting charged interest. Now, what's handy about that is it's really good to have a little buffer there just in case, especially as a business. If you've got to buy a stock, pay bills, pay wages, and you don't have the physical cash because you're waiting for customers to pay, then it's handy to have that little buffer there. Well, it's not handy is if you're consistently using it because that means that you're in a cash flow deficit. And if you haven't watched my video on cash flow, please go back and watch that. So it's definitely short term and it's definitely for cash flow issues. Up next, we have retained profits. This is when a business takes their profits and they save it over time. So they don't give it out as dividends, they keep a little bit back, and it usually has to have a purpose. Because if you turn around to shareholders and say, hey, we're not paying all the profits out, we're going to share some, they're going to want to know what for. And usually that's for some sort of growth. Now, the obvious disadvantage to this is that you can't retain profits that you don't have. But if you are making profits and you are retaining it, then what you can do is you can grow. And as you can see there, it says growth. You can grow without needing to borrow money. But again, this is a risky strategy if you're a PLC because shareholders want their dividend and they want the most dividend. And if you kind of diminish that because you're trying to save for the future, they're not going to like that. It's a concept of short termism. It's covered in one of my very first videos on this channel. Okay, up next we have share capital. So this is when LTDs and PLCs sell ownership of their business to recover some sort of capital. So you come to Mr. Giles and you say, hey, Mr. Giles, I want to buy some shares in your business. My business is worth £1,000,000. And I say to you, cool, you can have 20%. That's 200, that's 400 grand. Okay. 200 grand. I can't do maths. It's 200 grand. You give me 200 grand. So that's 200 grand capital for my business. And I give you 20% of my business. What that means is that you have a 20% voting right and you get 20% of the profits. That's a kind of generic way of how that works. Now, you could obviously ask to buy more and I could possibly sell you more. As an LTD, I don't have to sell you anymore. As a PLC, you can buy as many shares as you can get your hands on. All right. So by selling share capital, you are giving away voting rights, i.e. decision-making power, and a share of the profits. However, you are receiving large chunks of capital to grow and invest in your business without the need to borrow money. Now, remember, it all sounds like it's very good until the day that the business doesn't make a profit. So you, the shareholder, might have dropped your 200 grand in my pocket. I've taken it and bought buildings and machines, but my business still doesn't turn a profit for whatever reason. That means you just give me 200 grand and you get no return. You're not guaranteed a return. Now, you could try and sell your shares and all that kind of stuff, but really that'd just be a waste of your time, okay? Because you just give me that money, you've waited all that time and you didn't get a dividend. So just bear that in mind. It is a kind of low risk option for businesses, but quite a high risk option for shareholders, which is why they have that pressure to get their dividend. But as an intelligent investor, you're not going to buy shares in a business that isn't making profit, are you? Okay. Up next, we've got loans or mortgages. They're similar but different. A mortgage is specifically borrowed money to buy some sort of property, whereas a loan can be applied to anything, vehicles, machinery, that kind of stuff. They're both exceptionally long term. Loans and mortgages generally, well, mortgages definitely 25 years plus. Loans usually longer than a year. Okay, we're talking 5, 10, 15 years. Now, this is when you go to the bank gives you a preset sum of money and there is a preset payback, as in you have to pay X amount per month. That is its first downfall. It is a cash flow drain over a long period of time. And let me tell you this, folks, you will never ever be able to guarantee that you have the right amount of money 5 years from now, especially as a business. As an individual, it's tricky because you don't know if you're going to keep your job. But as a business, you don't know what cash flow is going to be like. So you don't know if you're going to be willing or able to make those payments. So there is a bit of a long-term cash flow risk. However, it's a large injection of money. And here's the real win of it. It's a bit of a business concept, like an entrepreneurial concept called other people's money. You are taking gambles and risks in your business using other people's money. So it's not your money. So if you're an entrepreneur, you go to the bank, you borrow 10 grand and you go and start your business. You, the entrepreneur, aren't really taking any risks, okay, unless you're a sole trader, right? But you're intelligent, you're going to be an LTD. So you're using and gambling the bank's money. Now, the bank's not stupid. They're going to do checks and balances to make sure you can do what you said you're going to do. But you don't need your own money to be able to be entrepreneurial. So it's that lovely concept of other people's money. Now, we call that gearing up. And we'll look at that in year 13. And we'll look at financial ratios. We call that gearing up. We want businesses to be geared up because we want to be gambling with other people's money, not our own. Okay. So again, this is for growth. Trade credit. Trade credit gets chucked in with sources of finance, but it's an interesting one because it isn't actually physically money. Trade credit is when you buy from a supplier and they give you 30, 60, 90 days to pay back. And it's kind of linked up here to debt factoring. Now, the reason why it's considered a source of finance is because if you're a business and you have cash flow issues, it's really handy to be able to delay the payment of the suppliers that you've got. Because what you do is you get your suppliers in, you get 30 days, so you can sell those suppliers, recoup and recover some cash, and then pay the bill. So it's a kind of a handy way of delaying cash flow. Now, there's a word I want you to use, please, folks. Here's the secret sauce. All right. I want you to use the word leverage. Okay. Trade credit leverages somebody else's cash flow, and it leverages your supplier's cash flow. So what happens is you get those suppliers sent to you, and you are leaning on their cash flow for 30 days because they are waiting 30 days for you to pay. So you are essentially using their bank account on your behalf, theoretically speaking. All right. Because what should happen is, like, if you go to a Sainsbury's, you load up your cart, you get to the till, you pay your money. Okay. That's not what's going on. You load up your cart, you go to the till, you put it in bags and go, call you back in 30 days. And then Sainsbury's carry on paying all their bills, waiting for you to pay whilst you're out there making money with all that stuff, being really entrepreneurial and turning their products into more money. So you're leveraging their cash flow. The problem being is that it can impact your relationship with your suppliers. If you get 90 days to pay and you take 89 days to pay, your suppliers are not going to be keen to give you large orders because they have to wait a very long time to recover their money. Also, the quicker you pay, often the bigger the discount that you get. So when it comes to a business to business transaction, if you've got a supplier and they give you 30 days to pay, they'll often have on the remittance slip, they'll say, but if you pay within a week, you get a 5% discount. And these are all economies of scale. So it's a bit of a tricky one. If you haven't got the cash, you've got to use the 30, 60, 90 days. If you do have the cash, sometimes it might be better to pay up front and get that discount to reduce your unit cost. It really does depend on your objectives. And then lastly, government grants is my favourite source of finance because I benefited from one many years ago. A government grant is essentially when the government gives money to entrepreneurs for setting up and running businesses in particular areas. Now, there are other reasons why they give out grants, but that's the one I'm going to focus on. So the government will say, hey, look, there are these areas around the country that we're trying to really rejuvenate. Okay, we're trying to bring them up. We've done loads of building of houses, we put money into schools, but what we need is people to have jobs. So if you're an entrepreneur and you can open a business in that area, we'll give you a cash lump sum of money that you don't have to pay back. You just keep it if you promise to do these three things. Hire some people, make some money, spend some money. Right? It depends. So you then get a cash lump sum of lots of money. Okay, and the quick personal story of mine is for my business that I was running. I got given £5,000 by the government for running my business in my area, and I never had to pay it back. And all I had to do was hire some people and prove that I was making some money. And they were like, wonderful, here's money. I was like, great, cheers. All right. So it's really good. But what it's not is it's not guaranteed. And it only gets given usually in places that are being rejuvenated. And therein lies the problem because they're probably places where lots of commerce isn't happening. Now, it depends on the business. Okay. My business was a big boot camp that I was running. So that was quite easy to get people there because I just put my boot camp in the deprived areas and got customers from everywhere else to come to it. Okay, fine. But if you want to open, say, like a car showroom selling Porsches in a quote unquote deprived area, rejuvenating area, you're probably going to struggle to sell Porsches. Okay, so it's not a guaranteed sum of money, and there is a bit of a caveat that comes with that. So that one is long term and it's designed for growth. Those are your major sources of finance. And now you know whether they're short run or long run, sorry, short term, long term, and when to use them. In the exam, the question might be, can you explain what they are? Or there might be multiple choice questions around the features, disadvantages, advantages. However, the 9-mark essay or the 25-mark essay is going to be about whether it is appropriate or not. And you just either have to take into consideration the context, especially if you're in paper 2 or 3, or if you're in paper 1, the context of UK business versus international business, okay? And a lot of these kind of hang on the balance of an interest rate of some description. So there's a little bit of context there as well. If you've got any questions, you whack them in the comments down below. I'll get to them as quick as I can. You stay safe, and I'll see you in the next one.